Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So, Matt, I think my biggest conclusion from prepping for this episode is that I'm really, really old. Both
Congratulations.
Both from the perspective of when this article was written that we're talking about, but also from the perspective that apparently I've been running like factor portfolios for 20 years now, which is just freaking crazy.
Don't you love when you go back to something that you wrote a while ago and you have that moment of being like, when I wrote this, I said, and I think you said 15 years ago in this one, but it's that thing about you're like, oh wait, I have to add more years to this. You go, oh no.
Yeah, if I ask Claude to rewrite the article, to repost it, I'm gonna have to change the number of years I've been doing this. But it is crazy just to think about, and just to think about how much this is all factor investing has evolved since I started. It's just, obviously it was what discovered well before I started, but the way people do it, the amount of ETFs that are out there. Basically when I started, I don't know if there were any, but there were very few. It's amazing, like the way the whole landscape has evolved.
It's so cool too, because, and I think this is part of why we wanted to revisit this one as a topic, is this is one of those things that as a topic for conversation, it doesn't go out of style, but little things inside of it are constantly like phasing in and out. And we can relate it back to stuff like why factors are or aren't working at a given point in time. And some of that's just like, what's getting arved out, what's not, what matters to people right now, what's not. There's so many other layers besides the really always interesting academic data in this. And that's part of why I love thinking about this with you, because I think we both kind of approach this mentally from two different angles. So it's well worth the update. I'm excited to talk through this today.
Yeah, so I probably should have introduced the topic. The topic is misconceptions about factor investing. And when you run these things for a long time, you talk to a lot of people who use them. And when you talk to those people, they have certain things in their minds about what factor investing is, how it works, how it should be judged, a lot of things like that. And a lot of those things are not correct. And so what we want to do today is, I think we've come up with 11 of them. We want to go through some of these things that are common misconceptions about factor investing, and maybe talk about why they're misconceptions, and then also what the reality is behind the scenes of factor investing.
Yeah, because there's a big reality behind the scenes of identifying the strategy from an academic perspective, the execution of the strategy from the professional or the vehicle's perspective, and then the end holder investor's perspective and how they do it. And that all muddies up the results that come out on the other end. So you can't really talk about one thing without talking about the other two, which I love in the nuance of this.
Yeah, so let's start here with the first one. And this one's not really as much of a misconception now as it used to be. And this particularly relates to value. So the misconceptions that are less risky than the market, and this particularly relates to value and people thinking about Warren Buffett and Ben Graham and all that stuff. And people thinking about, well, if I'm paying less for $1 of earnings, I'm buying like a more stable return. Like there's less risk in that stock than there is in a stock that I'm paying more for. And the reality is that just doesn't play out. When you look at a basket of cheap stocks ranked on any value metric, they tend to be more volatile than the market. They tend to be riskier than the market. And as we talked about in other episodes, that's in part, at least, what drives your return. So that's not a bad thing. But the idea that I'm going to buy all these companies at like a 5 PE or something, and that they're just, there's no risk in that because I'm paying so little for the earnings, is something some people think about this, and that does not bear out in the data.
It's really interesting because you can clarify this point for me. When you're talking about risk here, you're saying risk in terms of variance, even though we're invoking the traditional value cult leaders.
That's right. And that's part of what you have to do, is you have to think about how you define risk. Warren Buffett can tell you that risk is measured, over 30 years, and it has nothing to do with volatility. And it's, are you going to lose your money over a very long period of time, or whatever it is, like permanent loss of capital. That is a fair way to define risk. It's just unfortunately not the way, as dealing with investors on a day-to-day basis as I do. It's not the way, though, most of us as investors define risk. We don't define risk as, am I going to lose money over 30 years? Because there's a lot that goes on to get to those 30 years, and you're probably not going to be sitting there at the end of the 30 years if the risk in the middle is too much.
It's really interesting to me because this is both in terms of variance, which cuts in both directions, like things can do You can outperform to the upside just like you can underperform to the downside. So there's the two parts askew of this. And then there's just the reality. It's like, does Warren Buffett still love a good cigar butt today as he did then? And cigar butt meaning like the 50-cent dollars or the whatever the analogy was from all those years ago from Ben Graham. I mean, I think he does, but he probably likes it as much as Sir Mix-a-Lot still likes big butts, and he cannot lie. But there's the core truth in the thing, and then there's the, would this be a hit today? Is this as relevant today? Is this kind of weird today, but also kind of awesome today as a relic of history? And I think we have to hold those things in the same regard because, yeah, they're old ideas.
Yeah, Buffett has evolved, to be a little bit more quality over time, but also like the other thing people have to keep in mind with Buffett, and we're a little bit off track here, but the idea that, most of these types of investments that Buffett would like to invest in, he can't even invest in them. I mean, how many companies are there in the world at this point that Warren Buffett could actually buy? There's very few. So like, it's interesting to have the view of like what Warren Buffett was at the beginning, but what he has to be today is very, very different than that, just because of the realities of the pool of capital he's dealing with.
I'm really going to torture this metaphor, but in the same way that Sir Mix-a-Lot had to move on to fixing radios or whatever became his passion later in life, that's very different.
Is that true?
Yeah, he moved on into, FM receivers or something crazy like that. But he's really into it. He's apparently really good at it. And it's just, there's new chapters in life. So the same way Buffett can't stoop down to pick up those cigar butts the way he used to, those nets, those sweet, sweet nets, because they won't move the needle. He's got to focus on things like apples. Sir Mix-a-Lot had to evolve his strategy as well. And that's a beautiful thing.
I do like this idea, though. The next time a client calls me to panic during a downturn, I'm just going to tell them that risk is the permanent loss of capital and just hang up on them.
I
think that's going to go really, really well.
Absolutely. Absolutely. Nothing like reminding them of that.
Until we've sold it at a loss, there's no risk in this thing. So anyway,
which is kind of private equity in a nutshell.
I do wish, by the way, that we could not mark our stuff all day. That would be a huge advantage. Some days, all of us that manage portfolios in the real world, like wish we could be private equity. Wish we could just periodically mark the things nobody looks at. It would truly be fantastic.
And in a way, this is one of those reminders, and this is, I know we'll keep talking about factors on this, but this is one of those reminders in like the punch card lesson too, the Buffett idea that you only get so many, or you only have to take so many shots, you should make them, is the market's going to tell you the price. The market's going to tell you the value. You're allowed to say, I have my own assessment of value. I have my own assessment of what I think the markets are. And like, you can own something for 30 years and treat it like private equity and decide not to write it off until it's been absolutely zeroed, or just say you don't care about the volatility. It's just way harder to do in practice than it is to talk about in theory. It's a big part of why we're having this conversation today.
Yeah, so the first one is that they're less risky than the market. And the second one, and now that we've accepted the fact that they're more risky, is that you can diversify the majority of that risk away. And I'm a big believer in multi-factor investing. I don't think, like, unless somebody has some ridiculous conviction in value or momentum or something like that, we pretty much will always use an exposure to a lot of factors in a portfolio, because it's basically a free lunch type situation. But the reality is, like, even after you've done that, like, if you think about, if most people are judging you against the S&P 500, and I've built this really well thought out multi-factor portfolio, and even if I expand the number of stocks to try to limit the risk, if I do all that stuff, I still have one massive, massive risk relative to the market. And that massive, massive risk is size. Because I'm equally weighting my positions. I'm selecting, at least from us, we select from a universe of about 2,700 companies. I'm competing with an index that's the 500 largest companies market cap weighted. That size risk is going to be there. No matter what I do, that size risk is going to be there. And when you get one of these periods, as we have in recent years, where the biggest companies drive the market, you're going to struggle because of that. So the idea is, like, it's great to diversify as much risk as you can. But if I think about, I want to diversify all the risk relative to the S&P 500, I become the S&P 500. I start market cap weighting my positions. I start holding the largest companies in bigger share. Like, I take away a lot of the value of, at least over the long term, what these factors have been. So you're going to take risks when you do this. You're going to look very different than the market. How concentrated you are versus how diversified you are determines what that risk is, but it's always going to be there.
The way that you think about how this stacks up, and there's mathematical exercises and tools to help you do this, is really important. This is a big part of the approach to portfolio construction that I feel most aligned with personally, is admitting what you just said, that you can't, the more you diversify away from it, the more you just become beta. So if you know you're going to do that, you want to probably have a beta component in the portfolio and then decide what you want to be active with, in which ways you're going to specifically tilt away towards whatever it is that you believe in or that you're hardwired to do. But instead of layering in so many things, so you just ultimately become the market again, you have to figure out, how am I going to layer in stuff to be intelligent? And it's okay. It's okay if you don't want to do this either, but you just have to be aware of it. One of the worst things, I'm sure you've seen this a million times too, people come to you with like a billion different tilts and a billion different ideas expressed in the portfolio. And you're like, congratulations, you underperformed the S&P by 2% a year because you constructed the S&P in like a sloppier way. You can get away from that. You can, somewhere in there's I like big betas and I cannot lie. I don't know where it fits into this, but it feels like it does. But this is a really common mistake that people just stumble into because they want to get cute about it. And that's a problem.
Yeah, what do they call it? Mutual fund salad. Basically, when you get that portfolio that just has every mutual fund, like with every factor and every active manager, it's just this pile of stuff put together.
Thank God that this is one of those things that dies out as a class of investors die out. I don't say that like I wish harm on people. I just say it as it's a crazy thing for the people who were hitting peak earning basically in like 70s, 80s into 90s in the peak mutual fund years. And every once in a while, I'll still run into these. And it's usually a combination of the vehicles that were present, the brokers that were selling them, and what the clients were buying. Far, far less today than say 10 years ago, certainly 15 years ago in my business. But I would see mutual fund salad. I would literally get a portfolio and be like, you have, and I'm not making this up. Like I've seen like a portfolio with like, you have 90 different mutual funds of various share classes, sometimes the same fund in multiple share classes, compiled over the last 30, 40 years from working with somebody who was just selling you products. And you built a suboptimal S&P 500 or whatever else the mix was in there. Mutual fund salad is real. And it's like, that's the worst way to build a portfolio. It's not hard to just not do that.
And just on this point of risk before we wrap up, like the other thing to keep in mind is risk should always be looked at in a portfolio context. So it doesn't necessarily mean just because factor portfolios are riskier, it doesn't mean that it's going to add a lot of risk to someone's individual portfolio. It really depends on what they're doing with the rest of the portfolio. Like for me right now, like if I was somebody who was heavily in the S&P 500, I might, and Rick, we talked about this with Rick Ferry a little bit, like I might want a little small value exposure in there. I might want to play, because risk can be thought of in different ways. One of the risks is that the biggest companies don't perform well in the future like they have in the past. Well, mitigating that risk, one way you could do that is to put a factor portfolio in there, because a factor portfolio is going to be underweight those biggest companies and is going to be underweight size. And so I think you have to look at it in that context. And it's not one of those things like these are always these crazy risky strategies that add tons of risk to the picture if you think about it in a portfolio context.
Yeah, the financial planning corollary to this is you're looking for non-diversified assets all the time. You're especially looking for them when you're getting above average or above expected results. And a big conversation in the last, I would say, certainly in the last 2 years after we had the death of 60-40 in 2022 temporarily before it came roaring back to life, where like in a year like this, you go, it was easy to end up with an S&P 500 or a tech overweight or a large cap stock overweight. If you need to diversify that inside of stocks, that meant you probably needed to look overseas or you needed to look at smaller size. If you needed to diversify that outside of stocks, you might have been looking at bonds and things like that. These rebalancing strategies are really, for us, they have to be in line with the financial plan and this understanding of, do you need safer assets in the mix? Do you just need to spread that risk out inside of the asset class of equities? Do we need to do that inside the country, outside of the country? How do we do that to best meet the cash flow needs or the savings goals of the individual client? Those layers of consideration are just super, super important here.
So number 3 is kind of a corollary in this idea of diversification. And it's that more factors are always better. And this is a temptation a lot of people have that run factor strategies that use them is to like think about, well, what if I add this? And then what if I add this? Like once you get your major factor exposures in your portfolio, you're usually in pretty good shape. And there's a huge temptation to do a lot of data mining and to say, all right, well, like this little thing, I add that in and I add this in and I add this in. And suddenly I get again, I've diversified myself too much. And I don't have something where what I see in the past in terms of my results are as predictive of the future because I've just mined this whole thing together. So I think you just have to be careful about this temptation to say, let's add more and more and more factors to a portfolio.
I think of this one too as, so, I mean, anybody in the summertime who's had children coming over for a barbecue or whatever else has either picked a fruit tray or a fruit salad or something like that, so the kids aren't just loading up on potato chips and sodas and whatever else. When you select the fruit salad, perhaps the most important consideration is, are you picking something with some weirdo fruit that like none of the kids are going to like? And are there any fruits in your house that are like big no-nos that nobody will tolerate?
That's always my personal problem with the fruit salad. I can't stand the cantaloupe in there. It has no business being in there.
It has no business. Okay, so like this is one of the problems of, you don't necessarily need to have more factors to always make it better. Like cantaloupe is a losing factor in the forehand household. Or my problem is like, I like cantaloupe, but if I get cantaloupe and maybe Jack's family comes over, then all of a sudden I have a surplus of cantaloupe that I can't possibly ingest by myself in the days or weeks that follow. So kind of like constructing something around who's going to consume it, that becomes a really important lesson here. Because if you just pile it all in for sake of piling it all in, there's going to be waste inevitably, or you're going to disappoint people inevitably. And it's not a huge lift to just have that next step of intention. What am I doing this for? Who am I doing it for? Why? How does it serve my plan? How does it serve my long-term beliefs and investment strategy? How does it take care of the other people that this is supposed to take care of? Those are integral questions to doing this so that you don't end up with mutual fund salad, factor salad, and all the other crappy salads that nobody actually wants.
Yeah, and one of the things I've learned since I've had kids is like the battle here is not what's in the fruit salad. The battle is the Doritos versus the fruit salad. And you basically will say to the kids, I will put whatever freaking fruits in this salad you want. Like if you're going to eat this salad, there could be one fruit, there could be three fruit. I don't even care. Just eat the fruit salad and eat the Doritos.
There's nothing wrong with just getting a thing of blueberries or whatever if it keeps them off the Doritos. Because in the end, who can really compete with Doritos? Like you can't win that. So yeah, better to just.
So my son found that there's a thing of Doritos now that Pringles makes that's like one of those tubes that has like mini Doritos in it. And like he loves it. I've got to keep him away from that. But that's a tangent.
Canisters of Doritos. Yeah. All right. Well.
So on to number 4. Number 4 is the 3 and 5 year periods of the best for judging performance, and we've dealt with this a lot. But it happens. It's surprising. It happens a ton. You know, people, and we talked to Matt Favor about this. Like when he was on his podcast, he says all the time people will invest with him, and then they use that phrase you never want to hear, which is "we'll see how it goes." Like that is the phrase, like for me as a factor investor, I never, ever want to hear from clients. Because as soon as they say, we'll see how it goes, they're not saying like, we'll see how our relationship develops over time. They're saying one thing. They're saying, I want to look at the performance of this thing and I want to see what happens. And I want to make a decision with that performance. And if you look at these factors, they all struggle over 3 and 5 year periods. Multi-factor implementations that bring them together, they struggle less over 3 and 5 year periods, but they still struggle over 3 and 5 year periods. If you're going to judge these things over 3 and 5 year periods, you shouldn't use them because it's never going to work. And that's such a hard thing to get across, because sitting there for 3 and 5 years and like logging into your brokerage account every single day and see this thing's not working against the S&P 500 is really, really hard to do. But if you can't do it, you shouldn't be a factor investing.
The idea of mean reversion requires that you know you're mean. And it's one thing to look back over history and say, okay, 3 to 5 years, you get an idea for this. But anybody who's been allocating for more than a 3 or 5 year period knows the pain and horror. And there are academic studies that show this too, of like the pension fund managers who fire the people based on the 3-year number, and that being a predictor of like, those are the managers who are going to turn around and have a gangbuster following 3 years. These things are really cruel. So if your measurement period is 3 or 5 years, especially in a place with value, and I mean, you could tell me the data on how many 10-year periods even value underperforms in that. The reality is it's easy to fall in love with the wrong mean and be expecting the wrong mean for the thing you have. In most cases, it's a longer period than you would think. And it's really important to understand like what factors contribute to that getting closed sooner, what factors contribute them to getting stretched out. And sometimes the ones that are getting stretched out, you just definitionally can't know in advance. You just know, if I'm signing up for this, Mr. Value Investor, you are signing up for pain. You inherently don't like yourself in some deep fundamental way. And you're willing to take that on in the off chance that, you know, historically this is paid out, because once in a while it actually matters the price that you pay for something.
And the worst implementation of this, which I was dumb enough to get involved with like really early in my career, is when the client comes to you with the horse race. So the client is basically like, I'm hiring you and his other manager. I'm putting $100,000 with both of you. Whoever has more money at the end of a year, I'm putting all the money with them. Like I think we did that maybe one time, like very early in our career. And like, that is the worst possible thing you can do. Like if you say, I'm going to just over a 1 year period, I'm going to pick whoever does best and I'm going to put all my money with them, you almost always lose with that. It's a terrible idea, but people still do it because people are still using periods even as short of 1 year to judge performance.
I feel like this is one of those things that I'm pretty sure I've shared here before, but I read this earlier on in my career. I can't say I read it in like the financial crisis period, but I don't feel like it was that long after. It came from Barry Ritholtz, and it was a brilliant answer or reply to the horse race story. And he told a story at the time of a potential client, a prospect reaching out saying, I just inherited whatever, like $1 million, and I'm calling you and 4 other people, and I'm going to give you $250,000 each. And then at the end of the next year, whoever has the best track record, I'll fire the other 3 managers and give it all to whoever wins. And especially earlier in my career, that's one of those things when you're new and you're going like, that client sounds like, that might be a good business if you're starting from zero and you're an asset manager. That might be one of those things that you like gets your ears up and goes like, oh, like, okay, we can see prove my mettle of my value investing strategy or my growth strategy or my crypto strategy or whatever it is. But what I learned from Barry in this thing was the way he responded. And the way he responded was, do you know the story? Have we talked about this before?
I've heard it, but I don't know it. So yeah, I don't remember all of it.
So the brilliant thing, and this has been with me since whenever I read this for the first time, so we'll have to look this up because I'm thinking of this on the spot. The brilliant idea was that, and as he explains back to this person making this pitch, is let me just tell you what the flaw is and why I'm saying no to your proposition and I don't want this money. It's not because I don't think you might not find somebody good. That could happen. But really what you're doing is you're asking for perverse incentives from the people doing this. Because if I know the way I get to $1 million is I have to do better than these 3 other guys that I have no idea who they are or what they're going to do, I actually need, since I know I'm going to get 0 at the end of the year if I don't do this, I need to take an exceptional amount of risk on to basically try to beat those guys to clean up after the year. Because if in a year I'm basically getting fired unless I take on enough risk to outperform them, what's the point of even playing? So no, thank you. I don't want the money, but please understand the incentives that you're creating for the people who say yes to this is to take as big a swing as possible because they have 1 year to do something that's statistically impossible to do or really hard to predict that you can possibly do in advance.
This is why those stock picking contests in like high school where they try to teach people about stocks are like the worst idea of all time. Because basically what you want to do is if you've got to be the one in the class with the most money, you want to buy like the outrageous out of the money call option in something. You want to just buy something that has a chance to really blow up. But it teaches you 0 about investing because it teaches like taking, incredible amounts of risk relative to what you should.
Yeah. And granted, I know a number of those projects do track the students on risk adjusted returns and some of the other metrics to try to normalize this because I think some kids probably cleaned up after a few years of being like, oh, we just do like aggressive levered momentum trading strategies on like there's ways to do these things and game those systems too. But just this idea of like, you don't want perverse incentives to take bizarre risks. Factors give us a language to actually understand what those incentives are for the people taking the risks and why they're taking them. That's part of why they're so useful in understanding this kind of thinking.
Before we wrap this up, I just want to put this chart up because this really explains this whole thing. And this is from Larry Swedrow. It's an old chart, but the idea would be the same if it was updated. And then this is the number of 1 year, 3 year, 5 year, 10 year, and 20 year periods that each of the factors underperform. And what you see in here is what we were talking about, which is on a 1 year period, yeah, you've got greater than 50-50 odds, but the other side is very, very high. The odds on the other side are very, very high. And as you get to 3 years, it gets better, but there's still significant 3 year periods with all these factors where they underperform. Even at 5 years, there's significant periods. And so if you're judging something based on this, you're going to get yourself in trouble. Because if you're on the wrong side of these odds and you abandon the thing at the wrong time, you're probably going to miss the other side of that coin, which is, if I abandon value because if it's 22% of the time it underperforms after 5 years, the odds are the outperformance is on the other side of that thing. Because now the odds are probably more in my favor at that point. So it's just something to keep in mind when you run these strategies. And it's a good thing. I like to put this in front of clients a lot, just because if you're a client, this sort of sets the expectations of what you might see. Now, being able to see it in the real world is a different thing, but nonetheless, it at least sets expectations and lets you know that, yeah, this is going to underperform over 1 year. It's going to underperform over 3. It's going to underperform over 5. You're going to have to be able to endure that. And if you can't, you probably shouldn't be following these kind of strategies.
I love this chart too, not just for the table setting of expectations, but especially as you get into higher net worth situations or where the money's not all needed for consumption, but you're thinking over the longer term, the longer your time horizon, the more you consider other type of intelligent or intentional risks to take on. So if you need this money and it's part of your consumption strategy in like a 5 to 10 year window or even 20-year window, you got to be aware of these periods. And you have to be as aware of them as much for their underperformance as you actually have to be aware of them for their outperformance too. Because in the real world, where we're making decisions about this stuff, especially if it's for consumption, again, I want to know what above average looks like as well. Because I want to know if I knock the cover off the ball for 1, 2, or 3 years in a row with something like this, it's probably not going to stick. Here's all your 10-year examples of where this falls apart. If you got lucky and started value investing, in like 99 and you thought it sucked for a couple of years, but then 01 to 03, you just clean house with your small cap value, take some chips off the table. I think it's probably worth it. Knowing the above average results is as important as the below average when you start to stretch out these time periods.
So this next one is more of a semantic one, but I think it's important just to keep in mind because people use this word alpha all the time. So the idea is like once factors are widely known, the way I look at it is once they're widely known and they're available inexpensively, they effectively become beta. So, I mean, we have Fama French's work that if I buy low price to book stocks, I may generate outperformance over time. Now, that's a crazy example because you haven't done that in a long time if you bought low price to book stocks. But we'll assume we're in a world where low price to book stocks actually work. That is beta now. That is not like your manager can't come to you and be like, look at my alpha generating strategy. I'm buying low price to book stocks. That's not the way it works anymore. Like that's kind of your table stakes. And then you have to, beyond that, you have to do something else. If you want to generate alpha, you have to have something in your strategy to do something beyond that. So just the definition of what is beta has changed. Beta is not just beta anymore. Beta is like basic implementations of these factors, all of which you can get inexpensively now just by buying cheap ETFs.
This always makes me think of when I think about this of the Buffett's alpha paper. I think, is that a Cliff Asness paper? Do you know what I'm talking about?
It's an AQR paper. I'm not sure if Cliff was on it. I think he might have been, but
okay.
It's definitely an AQR paper.
The AQR paper that basically says, take us back. I'm going to let you explain this because I feel like you'll do a better job than me on this to the degree that I'm putting you on the spot with an academic paper. But like we didn't have words to describe this in the 60s. So it's really interesting to apply factor language to explaining what happens in that regression.
Right. So I can take these factor frameworks and I can take them back to Buffett's returns and I can say, can I explain Buffett's returns with these? And AQR found that you can. And basically what it was is a combination of value, quality, and I think there was some low volatility in there as well, and then leverage. So I take those factor exposures, I lever them up. I think it was 1.7 times. I might have that wrong. But anyway, that basically produces Buffett's returns. So you could argue, well, Buffett's, it's in beta all the time for Buffett. And that's really dumb. That's not true. And that's not what AQR was saying. AQR was saying, knowing what we know now, we can do that. But the reality is we didn't know what we know then. We didn't know what we know now then. So basically Buffett he didn't have Fama and French's work to lean on. Buffett was doing this himself. So the same exact thing was alpha back then, but now these types of implementations are more beta because we've learned, academic research is caught up. What's widely available cheaply is caught up. So it's just an example of, it doesn't mean because something is beta now, it was beta throughout history. That's not true. It means it's beta now because we've discovered things in the meantime.
This concept of we gain the words through science, I'm going to use science on this, through regression analysis, through understanding these things, through all the academic research that's led to the discovery of all these factors. They gave us words to explain something that happened in the past. But that doesn't just mean that we should just assume that it's the past thing going forward. Because the reality is, like you and I both read that paper whenever it came out from AQR. We said, this is cool. Did either of us go out and like create low beta portfolios and lever them up? Like I didn't go out and start an insurance company so I could have low price float to lever my returns. Like, did you do any of these things because you read this academic paper?
I did not. And that insurance company thing is so important too, because my cost to go leverage up this portfolio is going to be a little bit different than Buffett's cost to go leverage up this portfolio. So, it is like, it's a very different world that he lived in than what someone who tried to replicate this lived in. And also, as we've said, we've learned so much stuff since then.
What's really cool about it, though, is to go, great, we have words to describe what's happening. We have a way to explain the regression analysis on why this works and why this makes sense. But instead of let's go out and build that in a portfolio, what metaphorically can that teach us about other things that we do? And like a big part of that in the understanding of that in the paper is like, well, yeah, like how many clients have I worked with, or the parents where they made what would be considered boring, less growthy, low beta investments today that they just dollar cost averaged into for years, if not decades. And that turned into enormous gobs of money. Because when you start buying, I don't know, McDonald's at pennies on the dollar, years and years ago, and you just hold on and keep reinvesting money in dividends, going down to your broker once a week on payday, like amazing things can happen. And so it's a great validation of ways boring stuff can win over time, or the ways looking different from a benchmark can actually win over time, as long as there's some intelligent thought process to go behind it. It doesn't mean just because we can identify it with science or with math that it means it's a good idea that you should go out and steal from or implement. Alpha is one of those things that gets revealed as an explanation later over time. And then frequently, if it's a really good idea, it's going to get arbed away.
Just as an aside before we move on, what was also interesting about that paper is Lynch. Like, he was the one person they could not explain. Like, they couldn't come up with a factor explanation for Lynch. So like what he was doing, who knows? But I mean, he was obviously a very, very good stock picker. But it was interesting that like Lynch, there were no factors that really explained what he did.
And what's cool so we're talking about Peter Lynch, right? We're talking about,
Yes.
What was the name of the Peter Lynch book that everybody read?
One Up on Wall Street.
One Up on Wall Street. So,
Yes.
This idea of like, buy what you know, and Peter Lynch basically wove a version of growth investing in all these different people in a much different era from Buffett, or at least Buffett's start, where it was buy what you know. So it's like, oh, your kid's like going to this place. Like maybe that has a place in the portfolio because you have some version of like market research. If you combine the analysis of thinking about the company with some things that you can find these results. That's a totally valid and totally different style of investing. And guess what? Because it's kind of scatterminded, there's not a whole lot of ways to pin this together and say, this is what's going to work. This guarantees hits. I love that you brought up that footnote to the paper, because I think that's another really important takeaway that just reminds you of the idiosyncrasies of coming up with investment strategies that can have market beating returns.
So moving on to our next one, this is one we see all the time, which is the misconception I have is that factor investing is good for stock picking. And I have to explain that a little bit more, because one of the things that factors do is they work on average. So you build a diversified portfolio with a group of stocks with exposure to that factor, and you hope over time you're going to do well with that. Well, what you see a lot of the times with clients is they'll say, well, you've got these 20 stocks with exposure to this factor, these 50 stocks or whatever they are. Well, maybe I should just buy the 3 that have the highest score. Like, why would I have all these other ones when the highest score, according to your factor system, is these 3? And that's not the way it works. When you deal with deciles with factors, like the top 10% outperform the next one. But when you start to get granular in terms of every individual stock, it doesn't work that way. Like when we look back at our portfolios, like do the top 3 outperform the top 20? Not really. You're trying to get that diversified exposure to the factor. And just because, if you're looking at value, just because this is the absolute cheapest stock or this has the absolute most momentum, doesn't mean it's going to outperform the one that has the 50th. That's not the way it works. You're trying to get exposure diversified across a broad group of stocks to give you exposure to the factor.
You'll see a lot of this too in the academic literature around this. This is something I learned from Savita Subramanian years ago, but I've seen other people do this too, where you'll see people within those factor strategies kind of like cut the tails off. And they'll say stuff gets weird in that first decile and that 10th decile, or that top quintile and that bottom quintile or whatever else, and say, maybe temper your thinking around this stuff, because you don't just want to own the top 3. They might be there for a weird reason, especially from running a quantitative screen, and that might be worth avoiding. There were a number of strategies that got improved by just cutting those tails off and looking a little bit more clustered, because sometimes it's that thing that you're catching like on the upswing through the ropes or on the downswing through it, where you kind of want to filter it out when it's already landing at the extremes of the thing. Do you remember the Greenblatt Magic Formula website and that whole thing with, I think he shut it down over this. Do you remember this?
Yeah, no, I do remember this. Yeah. Yeah, there's the portfolios that were self-managed versus the one. Yeah, I remember that.
So one of the big things, Greenblatt writes the magic formula, which is still an outstanding book and still a great logical exercise to learn about this stuff and kind of honestly be in between. I always thought of that as sort of in between a Buffett and a Lynch approach, and tremendously useful because it also teaches you how to stack two related but not the same factors together in a concept. When they made the website for screening based on a kind of magic formula approach, they had these, correct me if I'm wrong, like the investors can make their own portfolios versus the algorithmically assembled portfolios. People wanted to just make their own and thought they would do better. Pretty much constantly, they did worse. And that was, you just couldn't cherry pick the stuff out of the data and do better than the simple algorithm.
Yeah, and that's for two reasons. One, because the absolute top stocks are not necessarily better, and then the second because of what we're going to get into here in a second, which is emotion. When you start putting your own decision making into these factor strategies, it becomes much, much more difficult. And that gets into our next one, which is that the biggest key to the performance of a factor strategy is the strategy itself. And it's not. The biggest key to the performance of a factor strategy is the person that uses it. 100%. Like I can test all I want in my spreadsheet and I can say, well, you get a little bit better return here. You get, whatever it is, I can run those stats all day, but you've got to believe in it and you've got to stick with it. And a strategy with a little bit worse performance that you believe in is pretty much always going to be better than one that's a little bit better performance that you don't believe in or that's too volatile for you or whatever it is. So that's so important to keep in mind because everybody wants to analyze these things in all kinds of depth, these factor strategies and every risk stat about them and all that stuff. But at the end of the day, it's got to be, do I believe in this thing? Can I stick with this thing in my portfolio?
This goes back to the concept we were talking about at the very beginning of this conversation of it's one thing to have the academic data and the regression analysis that explains the thing to you. It's another thing to build the vehicle that's going to execute on the theory. And then yet another thing, a third thing, to be the end investor who's going to own the vehicle that's going to execute on the academic strategy or on the idea itself. The behavior creeps into that second and third layer in a meaningful way, both in, if I'm the professional manager of the money, what things are going to creep into my own biases and tendencies to go, oh, I think the model's wrong. That's the first layer. But the second layer for the end investor is the vehicle going to do what I actually think it's going to do? And can I stick to it? I'll say it a million times, and it's another Greenblattism, but it's if you don't like broccoli, maybe don't do the all broccoli diet. There's a lot of diets out there. Pick something that you don't hate to try to give you the best odds of sticking to the strategy. The minute you make it something you hate in the strategy, the minute you show up at Jack's, barbecue in the backyard and it's all cantaloupe and he flips the tray over and tells you to get out and, get the hell out of here. You've already lost. You got to know yourself first. You got to know who you're serving first. It's an important lesson over and over again.
Yeah, I always look at this continuum from like an index investor to a crazy focused factor investor. And where you fall on that continuum is the most important thing. Like a lot of people should be index investors because even small deviations from the market in their portfolio lead to them making bad decisions. So those people should be index investors. Then you've got the people who have more broad exposure to factors. They can deal with a little bit or they can size it small, whatever it is, they can deal with that. They should have, small factor exposures. Then you have the people, and I'm one of these people who could sit here in these focus factor strategies and not do anything, regardless of what period of underperformance you see. But that is the exception by far for your average investor. So it's just important to figure out where you are on this. And going back to our discussion earlier, like sizing is so important here. Like it doesn't mean you can't use the focus factor strategy. It just means the focus factor strategy might have to be sized really small if you're somebody who can't deal with those ups and downs. So just getting yourself in that right place where I know, going back to that chart of those periods of underperformance, I know that if I see those periods of underperformance, I'm not going to do anything. It's so, so important.
I love that it's like index and focused is the corollary to basically, sane versus batshit crazy.
Which is me for these things, but it's not most people.
Well, I'm glad that you're willing to look at it that way. And I totally get it too. And this is where I go back over and over again. For most people, this is where it's okay to sin a little. It's okay to figure out what are the things that scratch the intellectual itch of the other thing that's pulling me and my curiosity and my interests into this. How do I do that in a way that doesn't blow me up the rest of the way? Because let's face it, it's just really hard. Investing is really hard to do better than those sane index broad market strategies. So you got to know why you're doing it if you're going to do it at all.
So my next one is that the past is always predicted of the future. And what I was getting at with this is like, I think, and I put an episode out today I did with Andy Constant, and we talked about this. I think in all areas of investing, thinking in probabilities is really important. And so I'm a huge believer in these factors. I'm a huge believer that they're going to work over the long term. I'm a huge believer that their struggles in recent years are part of that, and they're going to continue to outperform. It doesn't mean you don't evolve them, which we'll talk about, but it does mean like the core of this idea, I'm a big believer in. But having said that, are the odds that these factor strategies are going to outperform the S&P over the next 50 years 100%? No, they're not. The odds of almost anything in investing being 100% are very low. So you have to think about that there's always odds on the other side of anything I'm doing. If I'm making a bet on factor investing, I'm making a bet that I think there's a high probability that if I invest in these types of stocks, 30 years from now, I'm going to be pretty happy I did it. But that doesn't mean I can't be wrong. I could be wrong. I mean, over 30 years, these things could underperform. It's possible. And so I just think it's important to keep it in that context, no matter what. And this applies to anything. If I'm making a bet on an active manager, if I'm making a bet on anything, if I'm making a bet of stocks relative to bonds, I mean, all these types of things, you have the odds in your favor. If you know what those odds are, that's good. But the other side of those odds can come up sometimes. It's just part of the reality of it's what risk is. Risk is this thing that I think is going to work out might not work out.
So I fell down this rabbit hole, you'll appreciate this rabbit hole. I can share this with you. Everybody else listening, this is just Matt talking to Jack for a second. I fell down this rabbit hole because I was trying to remember, I knew there was a difference. And this is an example of like the words. I went down this rabbit hole because of this podcast that I released where the term came up, and it came from a marketing person. They introduced the term goodwill as it relates to bad will. And they were talking about relationships between brands and individuals or people and companies or professionals that they engage with. And I was like, bad will is really interesting. I was like, but goodwill, the way we think about goodwill has actually changed a lot over time. So I fell down this rabbit hole with, I think it was on the Deloitte website or somewhere, where they actually had like the history of goodwill impairments. And this is what I was really looking for, was accounting standards. When your definition includes things like goodwill and goodwill as an asset, do you remember this at all? Is this like a hazy memory of how like goodwill's been accounted for over like the decades? Because this is a prime example of what makes things like value investing so friggin' hard.
Yeah. No, I have some of this. You probably have more than me though.
This is go to the Deloitte website, look this up for yourself, but this is just an interesting rabbit hole to think about. Even the words we use change over time and then mean different things to different people. So in the 70s, they introduced goodwill and say, if in an acquisition, you mark the price up and you can't account for it as something, you're going to count that thing as goodwill. I'm grossly oversimplifying this. And then you're going to have to amortize that thing for the next, no more than, I think it was like 40 years or something like that. So businesses would be carrying an asset, a line item on the balance sheet that was marked as goodwill that they were going to slowly like depreciate over this period of time. But if you're looking at book values or you're looking at other things and you're trying to calculate it up, you'd be looking at the acquisitions of these businesses and you'd have this goodwill thing that's kind of a made up number at the end of the day. Well, what brought the assessments of goodwill to a screeching halt? Do you remember what lovely global event did that? I don't want to say the first time, but really finally got the FASB to change it. So in the tech bubble, you might remember companies were buying things and maybe stretching the amounts of goodwill that they're willing to pay. Slightly. We're not casting any dispersions. So the FASB has to come in and they have to go, we can't think of goodwill the way we thought about it in the 70s, because in the 70s, there weren't internet stocks and things like that. There's a massive overhaul that gets updated again. I can't remember, but like post financial crisis, same thing, where you have to change the rules for how you address impairment. Are you going to comment on it once a year? I think that was a 2011 or 2001 adjustment. And then 2011, again, post financial crisis, they have to think about this stuff again. And the lesson is, if you're a value investor and you're thinking about something, you're going, look how this worked over time. Look how this works when I think about this purely mathematically. Look how this works if I think I can set to it. You got to think about stuff like this that manually has changed in the calculation over time. Because what you're calling something today is not what somebody called something 30 years ago. And you're dependent on other people agreeing with you. I'm in this conversation with a musician and a marketing person, and they're giving me a definition of a word that is totally separate and apart from what the accountants would think of it as. So we think about how we look at the past data and how we look at who's going to arb this thing out and bring me back to reality. There is a mess under the hood here. It's just another level of what makes it so hard.
This is a great segue into our next one, by the way, which is that factor strategies are set it and forget it. Because just because people think all the time, I have to, I want to stick with my strategy. I want to stick with it for the long term. So they think that also means I shouldn't change it. I have this thing I believe in. I should just invest that way. I should use the price to book ratio no matter what. And no matter what facts I see, like I'm going to eventually be rewarded for using the price to book ratio. And we're picking on the price to book ratio here, but this is the idea. Like when you're building these strategies, you can't just say like, this is the way I do it and I'm never changing it. It's great to stick with them for the long term, but as you're sticking with them for the long term, you're also evolving them. You're also saying, does the price to book make sense? In a world of Google, does the price to book make sense? And, nobody would argue you want to evaluate Google with the price to book. It doesn't mean I got to eliminate it completely from what I'm doing, but it does mean I have to say, like, facts have changed in the world. As a factor investor, does this factor I've been using, does it still make sense or does it not make sense? And if it does not make sense, then maybe I want to change my strategy. And this is a very, very hard thing to do, which we're going to talk about a little bit in our next point. But you can't just say these things are set it and forget it. Here's my factor. Call me in 50 years. I'm not changing anything. That doesn't work. You do have to evolve these things over time as things change in the market.
The set it and forget it thing it's kind of like, I know I've said this here a million times. It's to me, the myth of passive investing. Like even if you own a Vanguard fund and you set it and forget it for 50 years, at some point money has to go in or money has to come out. And that means you need some understanding of the logic or the ideas, the philosophies around how stuff comes in and out. You can't just leave something alone because the example you just gave of like Google and Goodwill, there's a million of these, which are, this is the way we think something works at this point in time, but either the markets or your life or something else is going to change. You should have some robustness, some flexibility built into your philosophy. Otherwise, great if you get lucky, but if you get unlucky, it's going to come back to bite you and not in a pleasant way.
Yeah, this even applies to market cap. And I wouldn't, this is not going to happen in the real world, but just to give an example, like if we ever got to a point where, if some of Mike Green's stuff came true, if we ever got to a point where the largest companies accounted for an outrageous percentage of the S&P 500, maybe my idea that I have that my portfolio should be completely indexed, maybe I have to evolve that a little bit. Maybe I have to have some other stuff in my portfolio to counteract that risk of those huge companies. Anything with investing, you have to look at the facts. You have to see what's sitting in front of me today and say, should I change what I believe in? It's a hard thing to do, but you've got to be able to do it no matter what you're doing.
You got to be able to do it. That's why instead of market cap, I use forehand cap for all my valuation needs.
I don't even want to know what that is. But
it's a reference to your name. Get your head out of anything else.
But getting into the next one is this other idea that, and it plays into the same exact thing, which is that factor investing is free of emotion. And we've talked about on the client side, how it's not free of emotion because you got to stick with these things, but it's also not free of emotion on my side. Like I've got to build these strategies. I have to make decisions as to what's in the strategy. I have to make decisions as to whether to change the strategy. I am dealing with all the emotional things that are going on in the market, the bear markets, the underperformance. I'm being hit with that all the time as I make that decision about whether to change the strategy. So my ability to control my emotions or whoever is building the strategy, and this is true of anybody, this is true of even these cheap factor ETFs, they still have a team behind the scenes that's deciding how do we build this portfolio. And that team is going to make changes over time. And you have to trust that those people are going to make the correct changes. I guess in a lot of ways, the more focused the strategy is, the bigger this is an issue, because if you make the wrong change, you can end up having much bigger impacts, but it impacts it all the way across the spectrum. And it's just important to keep that in mind, because a lot of people think, oh, I'm a factor investor, so there is absolutely no emotion in this process anywhere. And that's just not true.
The investment committee at my company at Sunpoint, one of the things we were talking about in the last several weeks, certainly in the last several months, but we did a real deep dive in the investment committee on basically the growth manager universe, the growth managers we use, the things that are exposed, the things that are growthy. And the outstanding, overwhelming 2024 takeaway was you could basically lump them into the growth managers who were cool with owning a lot of NVIDIA, and the growth managers who had a very logical, very sane reason for either not owning NVIDIA at all or owning it in more limited quantities than the benchmark. And because performance in the benchmarks has been so disproportionately driven by a handful of stocks, but by and large, NVIDIA was like the funny common thing that you can see in every one of these managers. It just reminded you how much something sometimes can get reduced to an idiosyncratic bet. That middle level, that manager decision, especially for people who are hiring and firing or sticking with managers, becomes so critical that you understand, does the manager do what they say they're going to do? And do they actually stick to that over time? Because what I don't want in most cases is a manager who's going to be flighty in those decision changes. because there's a lot of risk in that flightiness. On the other hand, I full on respect that, man, I'm glad I'm not a growth fund manager, because in that growth fund manager, like that universe, these are savage numbers right now. And obviously the wreckage of the last, month or so has changed a little bit of that tune, but these are just, man, the numbers from a couple of months ago were just savage. If you owned it or you didn't, like that spread between the top and the bottom, just wild to see. It's friggin' hard to be a manager in the middle and communicate those values and then stick to them and not change them, especially when you're potentially hemorrhaging assets and your business is in decline.
What's interesting as an aside too, is like a lot of these large cap growth managers struggled with this idea because the growth companies became such a huge percentage of the S&P. Yeah. So if Apple, I don't know, do you know what percentage Apple is of the S&P right now? It's a high single digits or something like that, right?
It's still single digits in a meaningful way. It's still a top 10 holding. Yeah.
So if I have high conviction in Apple, like how do I overweight it? It becomes hard because it's such a huge portion of the S&P. And remember, what I'm being judged against is my performance relative to the S&P. So if I believe a lot in Apple, it's hard for me to take advantage of that because I'm getting to a point where I don't want to overweight it much more than it's weighted in the index. And so it became a problem. Like we interviewed a growth manager who had this problem. It's like some of these large tech companies, in terms of like what people would live with as a weight for a growth manager, the index got up to that weight. And so they had a hard time overweighting them.
It turns into, and I think this is a really important thing for individual investors to be aware of when they're selecting their vehicles or they're selecting their managers, is you want to be aware of how much customer base service or attention those managers are taking for why they're getting, hired or fired, because flows are going to determine the viability of their business model. This is a crude comparison, but I think it's an important comparison. Did you ever, this is such a stupid thing, but there was like some great boiler room or newsletter stock pitch math from years ago. Have you ever gone down this ugly?
No.
Okay. So a lesson I learned early on, and I think this was like a newsletter thing, but it was kind of like a behind the scenes look at like how this, those pop-ups on the internet or those emails where you're like, here are the 5 stocks that are going to crush in the year ahead, or the 5 AI stocks that own right now and all that crap. Okay. So here's like just an example of if your model is to either sell subscriptions or earn commissions in the boiler room days from like these stock tips, basically you would start with oversimplifying the math. I'm going to have 100 list of people. I'm going to tell 50 of the people that they should be long this thing to save their financial future. And I'm going to tell the other 50 people that they should be short this thing, or I'm going to be long some other stock or whatever else. And then you wait a week or a month or a year or whatever the thing that does. And you basically look at which one of my 50-50, the more like inversely correlated, the better, succeeded. And then I lose the numbers or the contact information for the people I got wrong because they're never going to talk to me again. And now I go back to that next 50. I'm going to split them 25-25 on the next completely outlandish idea and wash, rinse, repeat to just keep, oh my God, we were absolutely right. It's an A/B testing exercise. And it's an A/B testing exercise. It's not focused on you, the end user. It's focused on the vehicle and what accomplishes the newsletter sales or the stock commissions or whatever it is. You want to examine the ethic of the vehicle or the entity that you're going through to make sure that their math is at least in line with your math, your beliefs are aligned with their beliefs. Because if not, the extreme version of an adverse selection scenario is you get boiler room newsletter math being applied against you. And then you're like, oh, this person's a genius, or I can't believe I listened to that idiot. And that's problematic for everybody involved.
So I want to do 2 more. We have 1 more on the agenda, and then I have 1 more surprise I'm going to throw on you at the end here. But
oh, sure.
The one on the agenda is the idea that you should expect to match the academic results in the real world. And the reason I put this in is because some people don't recognize that academic factor testing is done long short. And almost all of AQR has some long short funds and stuff, but almost all of the implementation in the real world is done long only. And the reason this matters is because when you look at these academic tests, some of the return comes from the long side and some of the return comes from the short side. And if too much of that return is from the short side, then this might not be a factor I want to run long only in the real world. Now, the good news around this is the major factors all pass this test. The major factors all have return on the long only side. It's not a problem, but you just want to keep that in mind, because if the big return from the factor comes from shorting the stocks that are the worst according to the factor, then I'm not going to expect that to work very well in my long only ETF that follows the factor.
A really important takeaway from this that I think regular investors can use, we use it in portfolio construction, or I've definitely used it before when I with like individual security portfolio construction, you can look at factors that actually skew so you might use the long only factors to build your long only book as an input. You can use those factors though that skew on the short side. This really shows up in avoiding like bankruptcy risks in stocks. It skews heavily to like, there's basically stuff where they're good short candidates, but you can also use it as a mechanism, as a multi-factor part of your model on just things to avoid. So it might be a second or third step where you go, here's my long only stuff, the things that I want to own because they have a value or a quality or whatever else bias. But then I'm also going to filter for if there's any of these weird red flag raising things that work on the short side to say, let's make sure none of these companies or types of companies show up in the portfolio too. That's a way without actually shorting. You can use some of that stuff as like an avoidance strategy. And in the end, isn't shorting and avoiding kind of the same thing?
Yeah, well, I like this idea of using it as a filter because that's what we do. I mean, for all of our value strategies, we have a negative quality screen against them. And, one of the things, for instance, is like crazy negative momentum. We'll filter out anything that has crazy negative momentum. So that's an example of taking, like you said, taking advantage of the fact that we know that in the testing, like low momentum stocks did poorly. We can carry that in and not short the momentum stocks, but use them to filter against our portfolio. So that's a really good example of how you can do it.
Yeah, it's really important to think of it that way because, again, most people, unless you've been mired in these academic studies, you don't remember that or you don't know that these are, many of the studies are long short to prove the merits. They got to prove it just on the long side and all the other frictions and other quirky things that fall into it. There's frameworks for thinking through this stuff.
So the reason I put the bonus one is because I want to get at this idea that these misconceptions change over time. So what we believe about factor investing today, there's going to be some things we believe 10 years from now that are different. And we've talked about this on the podcast, but one of the things you could say could be a misconception about factor investing, we're still learning about it, is the idea that factors have to make sense. And this comes from the idea of Andrew Chen and Alejandro Lopez Lira, who wrote a recent paper where they looked at the factors that had behavioral and risk-based explanations, and then they just data mined a bunch of factors. They tested them historically up to the point that Fama and French's work came out, and then they looked at all of them going forward out of sample. And there was really no difference. If anything, the ones that made no sense did a little bit better. And so this might be something, if we're doing this in 5 years and 10 years, this might be one of the misconceptions we come up with about factor investing, is that factors have to make sense. And so I just wanted to put it in here as an example of we're always learning over time. That's part of doing this. Something that I thought really, really strongly about 10 years from now, I might not feel really strongly about, or 10 years ago, I might not feel really strongly about 10 years from now. And this is an example of something I'm coming around on, is this idea that maybe the factors that don't have to make sense. Maybe some of these data mine factors, if it's done properly, maybe they do deserve a part, a role at least in a portfolio. So that's an example of one, if we do this again in 5 years, that might be on the list that maybe is not on the list now.
What I love about this, and I'll stretch this out. I'm going to make this is a semi-tortured musical tie-in back to what we were talking about earlier, but it's this reminder that sometimes the thing that's a hit makes no logical sense, and we might be able to make sense about it later. Like we can talk about Buffett and the Buffett's alpha thing of having the terms to explain all the stuff well after the fact, but that doesn't actually truly explain it because you didn't have that way of thinking. Like you'd have to get in the time machine and do it just so. Alpha being a byproduct of those types of things. I'm thinking about, so I was talking about Sir Mix-a-Lot earlier. I need to write something about this. This is such an interesting thing. So do you remember the band, The Presidents of the United States of America?
Yeah.
Lump was their big hit. Peaches.
Kitty that's what I was going to say, Peaches. Yeah.
Yeah. All those songs. Great songs. Now on paper, the Presidents, I'll just call them that for short. The Presidents should not have had a hit song. On paper, they were doing weird stuff. Like the guitar had 3 strings on it and the bass had 2 strings, 3 instead of 6, 2 instead of 4. They were tuned down to some like weird thing. They're a weird band. I mean, Lump or Peaches are not normal pop songs. And even for like the 90s when stuff was weird, shouldn't have been hit songs. On the other hand, you had Sir Mix-a-Lot, who, Baby Got Back, and clearly all the follow-up hits that you can name and you can remember from
I was thinking if I could name another song by him, I cannot, I don't think.
So there's a crazy thing that I feel like it gets forgotten, but it was really good at the time. And I actually wonder, it's one of those things that's still like, yeah, I would actually go see that. So did you know that Sir Mix-a-Lot and the President of the United States of America actually had like a band together for a brief period of time?
I just thought about that.
So they had this band.
That seems like that would be an interesting band.
Yeah. I want to say it was called Subset, but like, this is a really interesting thing. You have 2 hit artists and you're like, they're hit artists that are probably one-hit wonders could we put them together? And there was some mutual like West Coast like scene respect or something else that like led them to each other. But they actually did some really freaking good demos. They had some really great songs. There was some like California's Got Rats song that I remember my friend Gary driving around listening to on repeat because it was just fantastic. But there's like the weirdness of sometimes something that makes absolutely no sense could be something that produces a hit. See Peaches, see Baby Got Back, or something that makes absolutely no sense. You can combine it and it turns into a dud. See Subset, Lost to the Sands of History. The future is unknowable. It is the factor ideas are one of many things that may or may not happen. And we have to remember that. The humility you have to bring to the table of this, it's just so friggin' important. Like, you got to live life for now. You got to figure out things you can do for now. The future is unknowable, but we're going to try our best when it comes to dedicating capital for long-term investments. And I'm going to go look for some Subset after this call.
I'm going to look for that as well because I want to see what that looked like. But that's probably a good note to wrap up on. I would say like and subscribe like all the hosts do, but I've learned in studying the YouTube algorithm that's literally irrelevant. It doesn't make any sense. It doesn't make any difference in terms of the views of your videos, although we would still love everybody to like and subscribe. But I guess the big thing you want people to do is you want them to share the videos and you want them to watch them to the end. So if you're here at the end, you've already done your part to help Matt and I out.
You had one job to watch the end. You completed that job. Feel free to like or subscribe or just, comment with your outlandish crypto recommendation, bizarro political theory, or favorite Subset track. I'd love to know some favorite Subset tracks from fans. I'm sure they're out there.
So just on that note, by the way, we do have like the same comment about something about I lost $70,000 that's on like every one of our videos now. And then like 257 people, like, obviously all fake things, all comment on it. So I have to like go through and delete all these because that same comment is now coming onto every one of our videos. So if you see that, nobody actually lost $70,000. It is some sort of thing that's like, and I'm sure coming in to save the day in that I haven't read it till the end, but some stock picker that they've come up with is coming in at the end of the day to save them after they lost the $70,000. I didn't make it till the end of the story.
See the boiler room math or newsletter math from earlier in this episode as your case in point of, consult a professional, not a YouTube commenter.
It's probably good advice. So thank you everybody for joining us and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.